Now let us discuss reverse repo rate. It is the exact opposite of repo rate. Now in this reverse repo rate, when the commercial banks have surplus funds with themselves, then they will keep those excess funds with the Reserve Bank of India and earn interest for keeping their funds as deposits with the RBI. The rate of interest paid by RBI to the commercial banks for parking their surplus funds as deposits with RBI is called reverse repo rate. When this reverse repo rate is raised, the commercial banks will be encouraged to park more surplus funds with the RBI, because if the RBI is paying better interest for keeping their deposits with it, then the commercial banks will earn more interest earning from the RBI.
Then more funds are used as CRR funds with RBI. This will lead to less credit creation ability by the commercial banks, and hence money supply will be reduced in the economy, thereby solving the problem of inflation.
And on the other hand, if the reverse repo rate is reduced, then the commercial banks will be demotivated to park their surplus funds with RBI. Instead of that, the commercial banks will use their surplus funds as a part of CRR, thus increasing the CRR, thereby increasing the ability to create more credit. This will then lead to solving the problem of deflation that is occurring in the economy. Now let's come to the concept of CRR, or cash reserve ratio. Cash reserve ratio is the minimum percentage of a bank's total deposits or net demand and time liabilities required to be kept with the RBI. The total deposits are going to be in the form of net demand and time liabilities. Now what is net demand and time liabilities? In order to understand this concept, we first need to understand the concepts of liabilities and assets. Liabilities and assets. Bank is an intermediary which accepts money from depositors and lends it to the borrower who is in need of fund. Depositors keep their money in bank in the form of demand deposits and time deposits. And to the borrowers, bank will give out loans. The demand deposits and the time deposits which are kept by the depositors with the bank are known as liabilities, and the loans which are given out to the borrowers by the commercial bank are known as assets. Let's look how. The demand deposits and the time deposits which are kept by the depositors with the bank has to come back to the depositors. Commercial banks have to give interest to the depositors for keeping the money with the bank for a period of time. And since the bank is liable to give the deposits back to the person who is depositing, and also payment of interest for the deposits received, it becomes a liability for commercial banks. But in the case of loans, the commercial banks lend money to the borrowers, and the banks will get this amount back from the borrowers. And on top of that, the borrowers will be charged certain rate of interest for borrowing money from the commercial banks, and that is how it becomes an asset for bank. So now coming back to the concept of net demand and time liabilities, we know what liabilities are: demand deposits and time deposits of a commercial bank. Now if you talk about net demand and time liabilities, we are not going to include any interbank claims, and by this I mean that some commercial bank might hold similar demand and time liabilities with other banks. Those demand and time liabilities are not going to be included while calculating the net demand and time liabilities. RBI fixes cash reserve ratio from time to time to regulate the money supply in the economy. We already know the concept of money or credit multiplier. It is calculated by using the formula 1 by LRR, LRR being the legal reserve ratio. And since cash reserve ratio is one form of the legal reserve ratio, we can use the same formula to calculate the credit multiplier. So using this concept, RBI varies the CRR to check and regulate the money supply in the economy. If there is inflationary trend in the economy, RBI raises CRR. In that case, for instance, let us suppose CRR equals to 4%, which means that money multiplier 1 by 4%, which is 100 divided by 4, which means 25 times. So when the CRR is increased by Reserve Bank of India from 4% to 10%, that means the new money multiplier or the new credit multiplier will be 1 by 10%, which means 100 divided by 10, which gives 10 times. This decline in the number of times money can be created by the commercial bank will solve the problem of inflation, as the commercial banks are now forced to supply less money into the economy. And conversely, in times of deflation, RBI reduces CRR in order to solve the problem of deflation. Now let us come to the last quantitative instruments used by RBI for control of money supply, SLR or statutory liquidity ratio. Statutory liquidity ratio is defined as the fixed percentage of assets in the form of liquid assets of cash, gold, and unencumbered approved securities which every bank must maintain with itself. Now what do we mean by the word unencumbered and approved securities? Unencumbered securities refer to those securities which are not acting as security or collateral for loans from central bank. Approved securities refer to those securities whose repayment is guaranteed by the government. Statutory liquidity ratio is also a form of legal reserve ratio. The rate of SLR is also fixed by the RBI and is varied from time to time to control inflation or deflation. A rise in SLR will lead to a rise in liquid assets to be held by the commercial banks with themselves. This leads to fall in the availability of funds for CRR deposits with the RBI, and therefore to a fall in money supply of commercial banks, thus solving the problem of inflation. And conversely, if SLR is reduced, it leads to fall in liquid assets to be held by commercial banks with themselves, which leads to availability of funds for CRR deposits with the RBI, which leads to the rise in the money supply and therefore solves the problem of deflation.